Good afternoon, traders. Welcome back to my weekend video. In this video, I'll be teaching you guys options my way and how I turned $1,000 into about 5K in less than 6 months. And I know there are a lot of options channel on YouTube, but most of them are very complicated. You have to spend so much time to look at the videos and break it down. And to this video, less than 10 minutes, I'll be breaking down very simple things and recap on what most people on YouTube said. For options, a lot of people try to bet on options, either go this way or either go up or go down, and then most of them lose money. And especially when they buy out of the money options and they don't have enough time for the option to exercise or for the options to move a certain way. So the timing is very important. And at first, I lose a lot of money, and then losing money makes me learn even better. So the timing is very important. And what do I tell you by timing? I do a day trade on options. Yes, people get 3-day trades. You can make potential loss of profit in 1 week on that 3-day trades. And I'll show you the times that I trade the most. Why opening 9:35 to 10? If you study the charts, you can see a big swing in the morning when you see Apple opens. Maybe it jumps all the way down, and then after 2 minutes, it gap up. So that potential range could make you about $60 to $80 in less than 2 minutes. And then I've been doing the charting every single morning, and I see, oh my God, a gap up, the gap must be filled. Or a gap down, the gap must be filled up. And why 10:30 to 12? 10:30 is when we know which direction the stocks are going. And the 10:30 Eastern time, this is all Eastern time. The 10:30 Eastern time is the 7 a.m. in the West Coast. So people start trading around 7 a.m. So most volume kicks in after 10:30. And you know what the direction is of the market by 10:30. And why 3:30 to 3:55? Because 3:30 to 55, most people whether sells it because day trading, or most people buy it. So based on the sentiment of the market that day, at the end of the day, you should see an opposite effect. So let's say we gap up a lot, and at the end of the day, there are a lot of profit takers and sellers. So at that point, you can buy a put and sell it within 20 minutes. You'll see the effect of stock going down. But those are just my opinion, and they're not always 100% correct, but most likely if you try that, and you can win back some money that you lost. And I've been doing that for a long time now, about a year. And then a year is not too long, but I have some experience telling you guys that. So those are the times that I recognize, and I use those times to trade options daily. Another one, factors. So don't trade options that has no volumes in it. So look at an option that has at least 1,000 people trading it, and open interest at least 500. So volume is that people are buying those options, selling options right now. And open interest are the people who are holding the options and try to sell them. They are open contract. So look at the big volumes and the big interest. I don't care about the Greeks because we're doing day trades. Greeks factors, they don't have any impact on my options. Unless you're holding over a day or a week, then you should look at the Greeks. But I don't, because I'm day trading the options. I don't care about the Greeks. They have no effect on me, on my day trading. Big companies, as I said, don't trade small options. Why? There are no volumes. The spread is huge. And you don't make money off small options, like penny stock options, or like small options, like you don't make money off that. What do? You play the big tech sectors. Why? A lot of volumes, you can get in and get out really quick. And there are some potential profit you can make if you can read a chart. And then some examples are the SP 500 ETFs, SPY, TQQQ, SQQQ. If you all trade options, you should know what those are. And then SPY, the SPY, is the biggest ETF for the SP 500 and the biggest option play in the whole tech sectors. So SPY, I trade that every single week. And then I don't play options like gold or oil or silver because their implied volatility is kind of high, and then their spread is kind of far away. and I'll show you what I mean by spread in a second. So how do you read the graphs? So we know that gaps, they tend to be filled. So if you have more than gap up, most likely within that 15 minutes range, it's gonna come back down to fill the gap and then come back up. Why? Profit takers. So what comes up must come down. What comes down, it will come back up. But just remember, selling, people who sell stocks and people who buy stocks, selling is easier than buying. So stocks come down easier than stocks going up. So right now we are still in the bearish territory. So again, same method. What comes up must come down. So remember that when you do options, when you see huge gap up, buy a put. I guarantee you, well, I don't guarantee you, but most likely 15 minutes of the time frame is gonna come back down. And if you buy 5 contracts, each contract make you $10, $550, less than 5 minutes or 10 minutes. And I'll show you about the MACD and how it crosses a line, determine when the stock will go up and when it will go down. And use option chains that's in your TD Ameritrade to know what the expected move is. Why do you know the expected move? So you know which option you want to get. Never buy out of the money options, aka OTM. Always buy in the money or at the money. And I'll show you a quick example of what I mean by that. This is Amazon and this is the option chain. So for Amazon, next Friday, November 16th, we have an expected move of $74.4. So Amazon is expected to move $74 up or $74 down. And let's look at a chart. NVIDIA, great. Let's look at NVIDIA for a sec. Let me show you what I mean by MACD. So this is the MACD. What happens when you see the blue line crosses the orange line? The stock tend to go up. And what happens if the blue line crosses down the orange line? The stock tends to fall. And then as you can see, there's the buying volume and the selling volume from the video. If you see the green bar fades away, there is a potential signal that the stock is going to go down in prices. So this is how I read MACD in the morning, and then I do my options 10 minutes, 15 minutes, really quick. And then at end closing, look at MACD real quick, get options real quick. In that 15 minutes, 30 minutes range, you will make some good lunch or dinner money. But that accumulates. So you know how we do it, and you do it every day, 3 days in a week. It's gonna accumulate up with the profits. So MACD important, reading the chart important, and I think that's it for today. Oh, one thing I need to show you is the NVIDIA next week. I'm looking at NVIDIA put 185. I'm going to do a day trade on Friday or Wednesday, depends on how it goes. And always buy big volume and big open interest. And I wouldn't get in NVIDIA right now because the implied volatility is very, very high, which means that you're paying a very high premium price. And it's going to work against you right after earnings. Why? Implied volatility goes down. So when IV goes down, your option becomes worthless. So never hold through ER unless you're very, very certain what's gonna happen for NVIDIA. So I'm buying an option either Wednesday, sell that Wednesday, or buy one on Friday and sell on Friday. And look at NVIDIA spread, 0.1 cent, so $10, not too bad. So yeah, NVIDIA is my play next week. Thank you for watching, and I hope you can finish this video and see you next